Welcome back, everyone, to another explainer. Today, we're decoding ASPE Section 3400. We are literally going to trace the entire lifespan of a transaction, from that exact moment an agreement is struck, right down to the precise second it actually hits the income statement. Let's get into it.
Okay, let's dive into this. When is a dollar truly earned? I mean, it sounds like a ridiculously simple question, right? You hand me money, I earned it. Simple. But, well, in the world of accounting, specifically under ASPE 3400, this is where philosophy meets cold hard practicality. Because earning, it's not just about cash changing hands. It's really about performance and, crucially, risk.
And here is the high-stakes reality we have to face. Recognizing revenue too early or even too late can completely distort your entire business reality. Seriously, this standard isn't just some dry compliance exercise for accountants to argue over in a back room. It's about telling the true, accurate financial story of a business. Because if you get this wrong, your financial statements, they're basically fiction, and the decisions made based on them are going to be deeply, deeply flawed. So, to make sure we get this absolutely right, here's our roadmap for today. We're going to cover 1. The core rules of revenue. 2. Splitting up multiple elements. 3. Playing the long game. 4. Principal versus agent reporting. And finally, 5. Special scenarios and exceptions.
All right, let's kick things off with Section 1, the core rules of revenue, the baseline of earning.
For a straightforward run-of-the-mill transaction, you can recognize revenue when you hit a very specific set of criteria. You need solid evidence that an arrangement actually exists. Delivery must have occurred or the service is rendered. The price has to be fixed or determinable. And of course, ultimate collection must be reasonably assured. But here's the really critical hurdle, the one that trips people up. The seller absolutely must have transferred the significant risks and rewards of ownership to the buyer. You can't just hold on to the risk of loss or damage and, call it a completed sale. It just doesn't work that way. But as we all know, modern business is rarely that simple, right? You're often selling a whole combination of goods and services together. Which brings us to Section 2, splitting up multiple elements, the bundle puzzle. Now, what's really interesting about this slide is the logic flow, which comes directly from the standard itself. When you're dealing with a bundled contract, you have to ask yourself a pivotal question. Do these deliverables have standalone value to the customer? Like, could they actually be sold separately? If the answer is yes, well, you can't just treat the whole bundle as one single event. You literally have to carve them out into separate units of account and then allocate the revenue accordingly. It's like taking apart a giant puzzle. Let's look at a fantastic case study from this standard to actually see this in action. HR outsourcing. Imagine you land a massive $1.275 million contract. And this contract bundles together payroll processing, an employee handbook, training events, and an executive comp assessment. Now, you don't just recognize that $1.275 million whenever you feel like it. No way. You have to estimate the relative standalone selling price of each specific piece based on your expected costs and profit margins. Then, and this is key, you allocate that total contract value proportionally across these distinct elements. That ensures revenue is only recognized as each specific service is actually delivered to the client. Moving on, let's shift our narrative from immediate sales to multi-year projects. Welcome to Section 3, playing the long game, long-term contracts. Okay, so when the timeline of a transaction stretches out over months or years, you generally have two methods to choose from. First up, the percentage of completion method. This recognizes revenue proportionately as the work is actually accomplished. But, and there's always a but, it requires a rational, dependable ability to estimate your progress. On the flip side, you got the completed contract method. You use this when the performance is just a single act, or, when reasonably estimating your progress is just practically impossible. In that scenario, you basically just have to sit tight and wait until the very end to recognize any of that revenue. Let's walk through the bridge construction case study to really make this tangible. Imagine a contractor has a multi-year project to build a 500-meter bridge. In year 1, they construct 100 meters. By the end of year 2, they've built 300 meters in total. And finally, by year 3, they successfully complete the full 500-meter bridge, the whole shebang. And this brilliantly illustrates the percentage of completion method in action, specifically using an input measure, a cost-to-cost method. So based on the allowable costs incurred to date versus the total estimated cost of the whole project, they calculate that they're 26% complete in year 1, 74% complete in year 2, and 100% in year 3. Why does this matter? Well, by doing this, they're matching their earned revenue and gross profit to the exact period the work was actually performed. It gives the users of those financial statements a true, reliable picture of the company's actual annual productivity, rather than a wildly distorted one. Moving right along, let's introduce one of the most hotly debated topics in accounting, in Section 4, Principal versus Agent Reporting, the identity crisis. The big question here is, when a transaction happens, do you report the entire gross pie on your income statement or just your net slice? Let's contrast the core criteria. You're acting as a principal, and therefore reporting gross revenue, if you are the primary obligator responsible for fulfilling the good or service. Also, if you hold general inventory risk, and if you have latitude in establishing prices, you're the one in charge. However, you act as an agent, reporting net revenue, if your supplier is actually the primary obligator, and the amount you earn is really just a predetermined fixed fee or percentage. The matchmaker example in the standard paints a perfect picture of this. So, Matchmaker arranges newspaper advertising space for clients for a fixed 15% markup. Now, they might hold a tiny bit of credit risk, but the newspaper, the actual supplier, is the one responsible for printing the ad, and Matchmaker's fee is locked in at 15%. Because the supplier is the primary obligor and that fee is fixed, Matchmaker must report revenue net. They only put their 15% fee on their top line, absolutely not the massive gross amount of the ad space itself. Finally, let's look at Section 5, Special Scenarios and Exceptions, the outliers. Because, let's face it, the business world is full of them, and ASPE 3400 is perfectly prepared for them. Let's talk about bill and hold arrangements. This happens when a customer buys goods but actually asks you to store them instead of delivering them right away. Now, you cannot recognize this revenue unless you meet a very strict mental checklist. So, the crucial point is the risks of ownership must have passed to the buyer, and there must be a fixed, unshakable commitment to purchase. Plus, the buyer had to have requested the delay for a real business purpose, there needs to be a reasonable delivery schedule, and the goods must be completely segregated and ready for shipment. Think of like a custodial warehouse. If the items are locked up, explicitly reserved for the buyer, and all those criteria are met, then yeah, you can recognize the sale even before physical delivery occurs. Then, of course, we have upfront, non-refundable fees. A classic example is a health club initiation fee, or maybe a telecom activation fee. You get the cash on day one, and the contract explicitly says it's non-refundable. So do you recognize it immediately? Nope. No way. The standard points out that because the activation or initiation literally has no independent utility to the customer without the ongoing service, it's not a separate earnings event. You actually have to defer that upfront fee and recognize it systematically over the expected period of the performance obligation. Which brings us to our final, somewhat provocative thought. Look at the numbers you report. Is your revenue telling the true story of your business? Now that you understand the actual mechanics behind allocating bundles, measuring long-term contracts, distinguishing agents from principals, and navigating those really complex exceptions, you've got a pretty powerful lens. Take these rules, apply them to the financial statements you work with, and ensure the story being told is firmly grounded in reality. Thanks for joining me on this explainer, and as always, keep learning.